All right, everyone, welcome back to the channel, which is all about income-oriented investing. I am joined by two very, very special guests today, a returning champion, Rob Wessel, co-founder at Hamilton ETFs and senior partner as well, Patrick Somerville. So guys, welcome back. Thanks so much for joining. Appreciate your time. And today we were going to talk about all about HYLD, HYLD, right?
Yeah, no, thanks for having us.
Yeah, so HYLD, very high yield. I get a lot of questions about this one. So do you guys. So there's a lot of questions. There's a lot of concerns. There always is when there's a fund that has, 13, 14 or over 14% high yield. So hopefully I'm speaking to the audience here. We're going to answer all your questions, all your concerns that we keep getting. So just before we start, make sure you guys refer to the disclaimer on Hamilton's website, hamiltonetfs.com/legal. So guys, we'll start right away. Let's get in it right away. So maybe we could start just by talking about what the mission and the point is of HYLD first, right? So right there on the website, I love how you guys have the objective, the mission statement right there. It's really to generate high monthly income from a portfolio of, covered call ETFs that have a broad sector mix close to the S&P 500. So it really is an income product, right?
Without question. So the fund was designed exactly for that reason, which was, the official investment objective is to generate attractive monthly income. How we propose to do that is to form a portfolio of constituents that have a sector mix broadly similar to the S&P 500, as you pointed out. And as we all know, covered call ETFs have a yield return trade-off, which is perfectly fine. Many people want to take the yield and the predictable yield, and they are prepared to give up some upside. So as we all know, the same portfolio with covered calls in a rising market does not do as well as a fund that does not have covered calls, and that's perfectly fine. In this instance, we have added a margin facility of modest 25%. The idea of the margin facility is for long-term investors is to help offset, maybe not fully, but partially offset that yield return trade-off in the hopes that if you believe the market will go up over your investment period, that the returns will be more representative of the broader equity markets rather than a strict covered call product.
Yeah, perfect. Thanks so much for that. So let's get in it right away because HYLD recently celebrated its 1-year anniversary. So we know that after 1 year, we could actually talk about the performance. Yes. And HYLD, you guys comparing it to the VSP ETF. So VSP, in case you guys didn't know, I'm talking to my audience here, is the Vanguard S&P 500. It's the Canadian listed ETF, and it's Canadian hedged because let's not forget HYLD is a Canadian hedged product. So it has underperformed VSP a little bit. So let's talk about the factors which contributed to that. So the first one would be the composition. So as we know, you made a few changes, I would say 2 major changes to HYLD in the last year. So in terms of composition, so the first one is adding JEPI. This was added, well, I call it JEPI, but it's JEPI, the JP Morgan covered call ETF. Very, very popular. It's by far the biggest covered call ETF on the US side. This was added in October of 2022, and it replaced the Harvest Brands ETF, greatly lowering fees, increasing yield, I believe, as well. And then there's JEPQ or JEPQ, which is JEPI's twin brother, twin sister fund, which is more of a NASDAQ oriented covered call ETF. That was added in early 2023, and that replaced TXF, the pure CI technology covered call ETF. So can you talk to me a little bit how the composition affected HYLD's performance?
Yeah. So for those who are maybe a bit newer to the fund, when it first started out, it was index based. We had 7 covered call ETFs. They were to be held in a equal weight, and there was an index attached to it. We quickly realized that we had a lot more flexibility if we could pick the funds ourselves. So we did a unitholder vote. Thankfully, we were given that permission. So what we started to do from there was to try to get the mix, incrementally closer to the S&P 500. That was number one. Number two, we wanted to make sure that we could support the yield. So, for example, I know you're going to ask in a later question, what happens if somebody reduces the distribution? So we'll hold that for a bit later in the video. The other thing we wanted to do was we wanted to be able to bring the fees down. We also wanted to do, and you were bringing up JEPI and JEPQ, is we wanted to be able to buy the funds. There's so many funds getting launched. We wanted the opportunity to potentially review and look at some of the newer funds, which is indeed what we did. So in terms of the mix, the mix was a variable in terms of the performance. There's a lot of, some things did better, some things did worse, but yeah, the mix was definitely a variable. But probably one of the other things that went with these switches, and we had identified this in the note. So every time we make a switch, as you know, Adrian, we write a note on our website and explain what we're doing and why.
Yeah.
We did say, taking some beta out of the portfolio. So the market had corrected. So if you thought the market was going to really bounce, there is a chance that these two things that we replaced, that we added, will not necessarily rise as fast as the ones that we had sold. That was correct in one instance, but we still think that the other reasons, which was a higher yield, a lower fee, more diversification, still put the fund on solid. Not that these other funds weren't good, but improve the fund for people who are long-term investors.
Yeah. And two things I would say about that. The changes were done pretty much at the end of the year or in the later part. So we still need another year, a couple more years to see. And like you said, this is really a long-term play. I'm all for the changes. I think your justification was right. I also like the fact that you could swap out funds. I think that's a big advantage that you guys have over other similar all-in-one products, which are, it's just their own funds. It's not like they could add another company's fund. So you guys have that flexibility. If there's a new one that comes in, or a new one that gets created, or one that's performing better, you could always do that swap. So in my opinion here, I think that's a good advantage. So, okay. And then a second factor is the withholding taxes, right? So HYLD does provide a lot of income compared to a VSP, which barely has any income. So there's almost no withholding taxes to think about for a VSP. So maybe get into how withholding taxes puts a little bit of drag on the return of HYLD.
Yeah, so this is by far the biggest variable in terms of the difference in returns between the VSP and HYLD. I should point out, just as an aside, the returns for HYLD and VSP have, for most of the history of HYLD, been pretty similar. So they were basically equal to VSP in July, in September, in November, and even as recently in January. So
I noticed that.
The difference between the two, but we're not trying to match VSP. We just think that's the most relevant bet. This is a unique fund. It's very, very different. So it doesn't really have like an excellent benchmark. What we do say, but obviously people who buy it want to know how it's doing and what's a reference point. And all we're saying is the VSP, which is S&P 500 index hedged to CAD, is your starting point, and then take into account some of the unique differences. So back to withholding taxes. So there's no question. I mean, the S&P 500 has a very low yield. So when you think about what's HYLD returns versus the VSP, for example, is just a simple crude reference. The percentage of foreign source income that is included in these very large distributions is quite high. Those distributions are subject to 15% withholding taxes. So our distributions are net of that. On the bright side, that negative delta is for taxable investors will come back to you in the form of your foreign tax paid on your tax return. So it's true that you'll see this as a fairly notable component in the difference, and you'll never see it in the total return. But having said that, you do get, for taxable investors, you're going to get all of that back on your tax return.
Yeah. So for taxable investors, that means if you hold HYLD in a non-registered regular cash account, you'll get, like usual for every fund, a T3 statement, and it's going to be there. So it's not like there's anything other steps for you to do. You give that T3 statement to your accountant, and you will get some of that back because of a foreign income tax credit. Is that correct?
Yeah,
Yeah.
it is, and it's unfortunate, and not unfortunate, but it's just a fact that it shows up. It's a decrement to total return.
Yeah.
Having said that, you still actually get the money in your on your tax return.
Yeah, and in case my audience doesn't really understand what we're talking about, inside HYLD, five of the ETFs, which makes up about 75, 77% of the fund, these are five ETFs listed on the US stock market.
Mm.
They're on the US stock market, so there is withholding taxes to pay. So if you would, for example, own a QYLD or a JEPI in your TFSA or non-registered account, that there is that 15% withholding tax. So just in case people, are don't know what we're referring to. Yeah, sure. Go
Yeah,
ahead.
in fact, you also have withholding taxes for the Canadian domiciled covered call ETFs. The distributions that get paid up to those Canadian funds also are net of withholding taxes. So, but it
Yeah,
is a through. But bottom line, when you have a fund that yields, into the teens, and a lot of it is foreign source, the simple fact is there is withholding taxes, and compared to one where there isn't, that can be a notable difference, which in this case it was.
for sure. A huge difference between
It
VSP
was
and
pretty big, yeah.
HYLD. Yeah, for sure. Another factor is the leverage. So this fund does use a 25% cash leverage. So this is, regular classic leverage, I like to call it. So you guys are borrowing money, but only 25% of the fund. So it's not very high. It's very modest. So this also played a factor because leverage
Sure.
costs have increased with interest rates, right? So maybe you could talk a little bit about this one as well.
Yeah, I mean, there's two variables. Well, arguably three. The first one is, unfortunately, as soon as we launched the fund, like 7 weeks later, there was a fairly significant macro correction. So that didn't help. So it wasn't the best starting date.
Hmm.
That's number one. Number two is, as you pointed out, there is a modest 25% leverage associated with this. The idea, of course, as we talked about earlier, is to ameliorate this yield return trade-off that's inherent to covered call ETFs. And of course, crucial to this, are you a long-term investor? Because if you're a long-term investor and you believe the markets are going to go up over your investment horizon, then this modest leverage should be your friend. And hopefully you don't really notice that much in terms of day-to-day volatility. But in this particular instance, certainly in the first 13 months, the markets are down quite a bit. So
Yeah,
naturally, if the markets are down quite a bit, leverage works in both directions. And in this case, it worked it added to the downside. And then the third component is, of course, rising interest rates. So rising interest rates aren't quite as significant as you might think because the amount of margin isn't very high. So for example, for every 1% increase, the annualized return of the fund declines by 25 basis points, or sorry, 100, excuse me. No, by 25. Every 100 basis point increase contributes or loses or adds 25 basis points to the interest expense.
to the interest.
Uh,
Yeah, it's 0.25.
yeah, exactly. Sorry, I'm
No, it's fine.
going.
It's good.
That's the right. So obviously, in a down market, it's 1.25. In terms of the rising interest rates, they obviously had an impact. I don't want to say on the bright side because none of those things are they're all negative to the returns. But having said that, again, for taxable investors, the interest expense is tax deductible.
Yeah.
And then lastly, I would say it's true you get 1.25 times on the market depreciation, which hopefully over time works itself out. But it's also true they get 1.25 times the monthly distribution.
Right.
So you're getting a higher distribution. So that the modest leverage isn't a total net negative when you think about what's happened from the date HYLD was launched until now. It's obviously supported much higher distribution yields, but it's a down market, and the reason it's modest is because if it is a down market, you hope it doesn't have such a big an impact. But it is one of the variables that contributed to this. Not call it 4.5%, give or take, negative delta between VSP and HYLD.
Yeah, I mean, this is, for me, I consider HEO a long-term buy and hold product. So you are
Yeah,
getting 25% higher distribution yield essentially with
sure.
that leverage. So if you're just buying and holding it, it's
Yeah,
always month after month after month, it's a benefit. And like you said, have a
yeah.
long-term horizon. The market was a pretty bad year in 2022. So
Yeah, well, there's no question it was a bad year, but as long as you're a long-term investor,
yeah,
I don't want to say you don't have to focus on the day-to-day movement of the units. The the NAV, but you are getting paid every month.
Yeah.
And over time, listen, eventually the markets are going to go up.
Yeah. Well, I hope not, honestly, because I love when the markets go down. I could just buy
No,
more. My whole philosophy is
yeah,
buy and hold and keep investing over time. And
right.
if you want the market to be down so you can buy cheaper units, that's just me. A lot of people think I'm
Yeah,
crazy, but a lot of people get it and do get it
yeah.
after a while
Well, we
of
like it to go up
followers.
eventually.
Yeah. Yeah. Hopefully we prolong that, but we'll wait and see.
Right.
Interesting. You said again, interest expenses. This is passed on to the investor. So if you have HYLD in a taxable account and a non-registered
Mhm.
account, you could actually get some of that interest expenses back. And again, it's going to be on your T3. Nothing
Correct.
you really need
That's
to
right.
do. You give that to your account and you do your tax, and you get some of the tax deductible, right? Kind of.
Exactly.
Okay. Perfect. Well, listen, I appreciate that. The last factor is really fees.
Mhm.
HYLD obviously has higher fees than VSP. I mean, VSP is just a generic S&P 500 index
Yeah.
ETF. So obviously it's going to have higher fees because, HYLD charges a fee and then the ETFs inside also have a fee as well. And there's leverage expenses as well. So that's a factor. But one thing I want to, and you mentioned this in your recent HYLD article, is that you are working on reducing fees by getting bulk discounts or discounts
Yeah.
on the fees of the underlying because HYLD is getting really big. So can you talk to us about that a bit?
Yeah, so this was a big benefit to doing the unit holder vote and unshackling ourselves from the index,
Yeah.
and obviously the growth of HYLD. And we really appreciate your audience and the people who have entrusted us with their savings, and so we don't take that lightly. So we are a forceful advocate for our unit holders, and as the fund got larger, we were able to do a couple things. The first is we were able to negotiate bulk discounts on fees. And this has actually been quite significant in terms of the impact that it's had on the combined management fees plus expenses, excluding interest expense, just
Yeah.
what gets paid in combination to us and the constituents. And we've also been able to swap out higher fee products and lower fee products. Bottom line is this has been highly, highly material.
Mm-hmm.
Um, so that's number one. So on a go forward basis, as it sits today, the combined management expense ratio, excluding financing costs, is about 1.25, 1.24. That number is down pretty significantly. We do feel that there's room to push that number down even further. But yeah, and so actually, interestingly enough, there are some all-in-one funds that have quote unquote zero management fee.
Right.
But actually now HYLD and HDIV now have a combined fee of top fund and constituents that is almost identical to these all-in-ones, which advertise zero management fee, which was one of the things that we wanted to do. But on the bright side, so it's not going to show up in the annual reporting that shows up on our website. That's not going to be reflected because it happened late in the year, but it has been highly material in our ability to push the fees down. We think that there's room for us to push them down further.
Yeah. So this is going on a going forward basis, like you said.
Correct.
So
That's right.
you're gonna.
Basically, 2023, you're not really going to see a meaningful benefit because part of the reason was the unit holder vote took place at a certain time.
Right.
We were locked in, and then we had to do preparation and consider substitutions and then negotiate bulk discounts. And so all of that took time. Bottom line is heading into 23, the combined fees are excluding interest expense are significantly lower than they were a year ago.
Yeah. No, it's like you said, this is great news. It's something I do want to hear from my fund managers. I
Yeah.
mean, let's be honest, you guys didn't have to do this. You didn't have to put in the work to book the meetings with, to negotiate these
Well,
discounts. So it's always appreciated on my side. I know it's extra work. So,
yeah.
and like you said, it's material. Again, think long term, not short term. And this is taking place right now, basically going forward. So, all right, let's move on to ROC. So HYLD just, the tax breakdown are now available for all funds. And as I personally expected, there's going to be a significant portion of ROC, especially in a down year. So maybe we could touch base on this a little bit. So there's a lot of misconceptions about ROC. Most new investors, they check out the definition, they see the technical definition is your own money coming back to you. they think it's a bad thing. They think it's a scam or whatever. So what would you guys say about ROC in general and how covered call strategies ROC is fairly normal?
Sure. So yeah, I'll field that one, Adrian. So first off, just wanted to clarify in terms of the tax factors of HYLD and its
Yeah,
sister HDIV. The tax factors are a reflection of what's happening with the underlying ETFs, right? So when you
right,
see return of capital, dividends, all those things that make up the tax factors, it's basically it's a flow. HYLD is a flow through vehicle, right? So all those are coming from the underlying ETFs. That's the first thing to keep in mind. But yeah, on the topic of ROC or return of capital, it's definitely a polarizing topic. There's a lot of misconceptions, but our view is that there's two main sources of ROC for investors to be aware of and just to consider when they're looking at covered call ETFs. The first, which is often called bad ROC, this is where there's essentially an encroachment of capital, where the fund is essentially giving back your own money. This is obviously viewed negatively, especially if the ETF is using a large percentage of that to fund its distribution, right?
right.
There is a lot of things going on in the distribution management of covered call ETFs. They want to have stability, and some companies pay dividends quarterly, and so they want to pay monthly. So there might be some ROC just to support the dividend management or the distribution management of it to keep things consistent. But you just want to be aware if there's a large, if it's coming out of your capital to fund very significant portion of the distribution, that's obviously would not be a good thing. And then secondly, there's what's called, often referred to as good ROC. So this is a common feature in covered call ETFs and what you were alluding to earlier, Adrian. So this comes from the option strategy. So the premium income that's earned by the fund, that's generally classified as a capital gain. However, at the end of the year, if the fund has realized capital losses or perhaps they have tax loss carry forwards from previous years, the fund can use those losses to offset any gains in the portfolio. And then what happens is those gains are essentially reclassified as return of capital. So it's basically a reclassification for tax purposes. So this is common with covered call ETFs, particularly in down years, as you pointed out. And I think the other thing to point out about this topic too is that there is a tax efficiency element to return of capital. It's essentially from a tax perspective, the return of capital component is not taxable when received, right? So
Yeah,
what happens is your ACB lowers, and effectively you pay tax when you come to sell the investment. Hopefully the investment is up over time, and that will be taxed as capital gains, which obviously is more favorable than dividends or interest income, for example. But generally speaking, just covered call ETFs have tax efficiency because your tax breakdown is a blend of dividends, cap gains, return of capital. Then in the case of HO, there's some foreign source income as well.
yeah, and that's why I like covered call ETFs. They are very tax efficient. There's always going to be some ROC in there, and I like that it's completely tax free. Of course, if you have it in RSP TFSA, doesn't really matter. But in a non-registered account, if half the income for the year is ROC, well, you're not paying taxes on that. Yeah, it lowers your adjusted cost base, which means when and if you do end up selling years from now or whenever, you do have to pay the capital gain. This is why personally I just tell people I consider ROC as deferred or delayed capital gains. And as we know, capital gains is pretty tax efficient in Canada, much more tax efficient than dividends, even in higher tax brackets, typically when you're making over 100,000 a year. So thanks a lot for that, Patrick. Makes complete sense. You see I just thought of it because, it took me a while to understand ROC and why certain covered call ETFs year after year after year always have some of them have all ROC. For example, the gold ones. So I remember seeing this gold covered call ETF that's been around for 7 or for a really, really long time. And every year it was ROC income. But then when I went back and saw when the fund was created is when gold was at the top. And then throughout the years, it just went down, 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 which means, okay, this is all capital losses. So all that covered call income is being transformed into ROC, basically. So I had that eureka moment, which finally made me understand that ROC was, not a bad thing necessarily. So
and so I would just tag in too. I mean, these things are complicated, so it's completely understandable that if you look at the YouTube comments or things like that, that there are people that aren't sure, or maybe they think good ROC is bad ROC or whatever. But unfortunately, all that's very understandable. This is all extremely complex, even for, industry experts. So it's perfectly reasonable that some people might not know immediately what the differences are, what the implications are.
Yeah, and at least right now, most brokers in Canada adjust your ROC for you once a year. So there's
Yes.
that also worry that people have. Well, how do I know what my ACB is if I'm getting ROC every year? Well, as far as I know, every broker now adjusts ROC once a year, typically
Mhm.
March or April. So you don't have to worry about tracking that as well, which is great.
Also, I'd tag in with, because it's adjusting the cost base. It does, unlike say buying a stock, make it a bit more tricky to say, here's my price return. So
Yeah,
I bought at X, and I now see it's something different from X. That difference, up or down, isn't necessarily your return. In fact, there's a good chance in a covered call ETF, it's not your return because there's some ROC component which has brought
yeah.
down your ACB. And so that makes, to add to just the sheer complexity of all this stuff, that even makes just trying to measure price returns tricky.
Yeah, and that's exactly why I track my own stuff in an
Yeah.
Excel file because I don't want the rock to be in there. So my book price does not include the rock, which if it,
Yeah.
over the years, after 10, even 10 years plus, your ACB could hit zero. It could hit zero. So I don't want that to show up. Anyway,
Well, hopefully not. We hope that everything in the underlying is, its NAV will keep rising for all kinds of reasons.
yeah. All right, thanks guys for that. Now let's talk about another big concern, the dividend or the distribution sustainability of
Sure.
H yield. So I always tell people, and Patrick, you touched on it, H yield is just a flow through fund. I typically call it a middleman fund or a placeholder fund. So maybe you guys could talk about, H yield's distributions, how are they sustained, what's the approximate payout ratio, and how do we address concerns of investors who say it's not sustainable?
Sure. So yeah, this is definitely a frequent question for H yield and again HDIV, it's sister ETF, both because they have significant dividend yields. So
Yeah.
that's a natural question that would come up. So like you said, and like I said earlier too, like they're flow through vehicles. So we're flowing through the distributions of each of the underlying ETFs. It's increased obviously a little bit by the leverage that we use, the modest leverage of 25%. So we're flowing through the distributions, approximately the distributions of the underlying plus the leverage of 25%, right? So, the flow through is not precise, like it's not exactly the underlying plus the leverage, but it's very close on average, right? And so, some of the underlying ETFs, they do have some variability to their dividends.
Yeah.
As we mentioned earlier, the objective of this fund is to deliver, attractive monthly income and stable. We think a lot of clients that own the funds, they like to have stability in the underlying distribution yield for planning purposes, for cash flow perspective. So it's not exactly, but it is very close to the underlying plus the leverage, I would say. In terms of sustainability, obviously nothing's guaranteed. Different market environments you could see some distribution decreases from some of the underlying, if you were to go through a period like that. But one of the things we've done with both HDIV and H yield is seek out ETFs that have very solid, stable distribution history. So that's a key criteria in our selection process. But that being said, if one of them were to, or if several of them were to reduce their distribution, it would no doubt place some downward pressure on the yield of HDIV and H yield. But there's a couple of things I think that are important to consider if this were to happen. Number one, both ETFs, HDIV and H yield, are very diversified, right? So we own a number of ETFs. They invest in hundreds of stocks that are supported by dividends and are also supported by their underlying option strategy. So there's a lot of just diversification in each of the ETFs,
Mm-hmm.
and the fact that we own a lot of different ones in the two portfolios. But let's say a constituent ETF were to reduce its distribution, the overall impact to H yield, for example, would really be limited to the weighting of the fund. And the largest weighting we would have in H yield right now would be around 17% of the fund. So there is a diversification component that protects you from these things.
Yeah.
One or two would have reduced their distribution. And then finally, as we talked about earlier, like we do have the flexibility to switch to other ETFs should this occur. If we're not happy with the dividend policy of one of the underlying ETFs, this industry is constantly evolving. There's a lot of selection to look at, and
Yeah.
we could theoretically look at another ETF to protect the dividend yield of H yield.
Yeah, I think that
Can I tag in with one comment?
yeah.
Yeah. So all of that's exactly right. There is an exception that the Global X and the JP Morgan ETFs, they have some variability in their distributions, which we're well aware of. And that's perfectly fine because the yields of them are extremely high. And they have their own sort of idiosyncratic nature. So what we do is, especially for people who like those funds, but as Pat pointed out, want consistent distributions because they're living off of those cash flows, monthly cash flows. What we've essentially done is said, okay, well, let's find what we think is a midpoint, if you will, and let's pick that. And so we'll try to be in and around that number, so that we've essentially tried to diversify the distribution variability within that small cohort. Actually, I guess it's not small, within that cohort, in order to kind of give the holders of H yield consistent monthly distribution. So as Pat pointed out, everything that's been in the fund, we've evaluated the distribution history for these few over here, which are very focused on volatility. They do have the distributions, come up and down. We've tried to essentially find a midpoint and work with that. So I just wanted to add that caveat.
Yeah, no, it's good that you had took the midpoint, not the high point.
Yeah.
Right? Because if you would take the high point and then, you could get maximum yield, but then let's say volatility calms down. I know that JEPI and JEPQ give out higher distributions when there's higher volatility. But if you took the high point, markets go back to normal when, well then the distributions could reduce 10, 20%. That wouldn't be good. So you guys actually took the midpoint, which I like hearing.
We're trying.
Yeah.
Our estimate of the midpoint, because we can't predict volatility as it relates to the underlying, but suffice to say, we're doing our best to try to smooth that out. Is
it accurate to say that the payout ratio will always be approximately 100%? Approximately, sometimes a bit higher, sometimes a bit lower, and I'm talking about 100% vis-a-vis the combined distributions of the funds inside of it, of course.
Yeah, I think what we would say is that it's not always going to be 100%, but
it could be different month to month, but it's in that range of 1.25 because that's the leverage, right?
Of the underlying, and then we may, just to smooth things out, to keep it, if there's some variability to the underlying, we would want to keep it consistent given the feedback we've received from clients that they don't want to see a lot of variability to the different.
Yeah, exactly. No, I mean,
and I'll just tag in too. There's no structural grind to H yield, so we haven't decided, or H div for that matter. We haven't said, here's the weighted average yield of the underlying times 1.25, and we're going to take that number and multiply it by 1.3 or something like that. So there, as Pat has pointed out, for the most part, it's going to be the average of the underlying times 1.25, but that number is going to bounce around.
Yeah.
What is important to point out is we haven't said, oh, it's this times 1.25, and then we're going to tack on a big cushion because we think people like to see a bigger number or whatever. We don't want a structural grind in the fund. We want the NAV to go up over time. We know a lot of people, we see the YouTube comments, and some people are not sure if there's a structural grind to certain underlying ETFs, and whether or not the adjustments to NAV, as Pat pointed out, are structural, will always continue until you're at zero or something like that. If you look at everything we own, the NAV has gone up over time, and we would fully expect that to be the case for H yield and H div.
Okay, so you guys are basically against overpaying or grinding the NAV, right?
Yeah, we're not ideologues. We're trying to be close to that times 1.25, but we're not overly excited if it goes up a little bit, and hopefully it gets down. We're trying to be practical, and we know our unit holders want stable distributions. So if some of the underlying bounce around a little bit, we're not going to run around and chase it up and down. We're going to find what we think is a reasonable number over time.
Yeah, and like Patrick said, if any of the constituent ETFs inside, let's say, reduce their dividend, let's say Q yield reduces their dividend 10%, although that's kind of hard to say because it jumps around every month. But it would only impact HYLD in a very small way, because if Q yield's only 15 or 16% of the fund and it was reduced 10%, then the only impact would be less than 2%. It would be like 1 0.6 or
Yeah.
1.7%. So, and on top of that, I like the fact that you guys have the ability to swap for other things if you find that they're more consistent, they're a bit higher, they have better tax treatment, et cetera, et cetera. So I think that's a big advantage of HYLD and of HDiv as well, because it's, you know, it's the same style product. It's a product that holds many other
Yes.
diversified products. So
Exactly right.
all right, so I think we pretty much covered. Yeah, I think we've been here for almost 50 minutes. I could talk to you guys all day about this stuff, but you know, I'm sure
So
you have other stuff to do. So maybe some final comments. I think we've addressed most of the concerns that I personally get and you get as well for HL. It's definitely
sure.
the dividend sustainability, the share price,
Yeah.
and things like that. So maybe some final comments from you guys if you want.
Yeah, I'll weigh in. So first of all, we do appreciate all of the support that we get and the confidence that your followers have placed in us, and we take that seriously. But yeah, I mean, the market is you know right now is not great, and so things are bouncing around. And obviously, you know, we wish the market had gone up after we launched HYLD. Having said that, it's you know it's been bouncing around. It's been pretty close to the S&P 500.
Yeah,
Also important. VSP, I should say, hedge to CAD. Also important, though, is there's very high correlation. So
yeah.
we really want to get closer to the S&P 500. We know, you know, it's not always going to be exact, but we just, you know, that's our reference point. And so we feel that the fund has done what we wanted to do, which is we feel that it's delivered consistent monthly income that has been, you know, from with higher distributions. We feel that it's been very correlated to the S&P 500, and we feel that you know for almost the history of the fund, its returns have been very close to VSP. Yes, they've deviated more recently, but these things do bounce around, and we're optimistic that you know some of that gap will narrow. There is some of it which is structural, withholding taxes, which we've talked about, that people will get back. And then lastly, I would say we are still very focused on supporting the yield, reducing the fees, improving the correlation to the S&P 500 because there's always work to do, and trying to make sure that we do what's right for our unit holders.
Excellent. And yeah, closing comments from me anyway. I'm going to speak to my audience here. Don't forget the point or the mission of HYLD, guys, right? It's not a total return product. I know people are obsessed with that. It's really a monthly income product. And in my opinion, the fact that, and you pointed this out earlier, that throughout the year at a few times it was right on par with the S&P 500 is very, very impressive for me, because the S&P 500 is extremely hard to beat. It's, you know, the king of kings when it comes to the benchmark. So the fact that it never missed a dividend, never cut its distribution, made what I feel are great changes, and the fact that it's fairly correlated, or it's been on par with the S&P 500 quite a few times is very impressive. So for me, it's doing its job. It's designed to maximize monthly income, and it holds some of my favorite US covered call ETFs, which I don't have to own individually now. I could get it all in one package with a little bit of a boost, 25% leverage, which I absolutely love. So yeah, I mean, it's a great product. Same thing for HDiv, right? It's kind of like the Canadian market equivalent.
Oh, absolutely. And I should also point out that we have said many times in the past, and we've said it in this forum, we do believe HDiv and HYLD are highly complementary. And we actually, and I know this sounds self-serving, but we do think that they should be held together because the Canadian equity markets are highly complementary in terms of their sector mix.
Yeah.
And if you go on our website, if you had a 50-50 portfolio of HYLD and HDiv, your return was nearly identical to a portfolio that was half XIU and half VSP. So that's, you know, from our perspective, we're very happy with that outcome.
Yeah, I mean, they are complementary because on the US side, it's mostly tech and healthcare. On the Canadian side, it's more financials, materials, energy focus. So you own both of them together, and you have really big, great, broad diversification.
Yeah, we think so.
Yeah, for sure. So guys, I'm not going to keep you longer. Thanks so much for doing this. Appreciate your time. I know the audience will appreciate this. Hopefully it answers most questions and concerns you get, but you guys, you are still accessible. You could, the audience could contact you guys via your website, right? If ever they have more questions, or there's even a phone number, I believe.
Well, it's probably the best way is info@hamiltonetfs.com.
Okay, email, yeah, and
Yeah.
I know I'll keep getting the questions as well,
Yeah.
so it's all good. So hopefully,
We'll continue to do our best to put out updates on the funds too, and keep the information flow coming on our insights section, which is a good place for people to go through some of these questions as well. Which
yeah, definitely love those articles. Whenever you guys do anything major, you post an article about it. So another thing, my audience, in case you want to read more, go on Hamilton's website, go on HYLD, and you'll see the articles relating to HYLD, and you'll see the ones. A lot of the stuff we talked about are actually in there. The information is in there. So again, thanks again, guys. Much appreciated, and we'll have you on again, of course. See you next time.
Thank you. Thanks, everyone.
Hey, don't go yet. I have some important reminders, including some more recent ones, and I'll try to keep it as brief as possible. And for everything that I'm about to discuss, the links and info are in the video description below. So first of all, if you didn't know yet, I do offer a one-on-one coaching session where you'll have a 1-hour Zoom call with me where you could ask me all the questions you want, and I'll help you and assist you best I can. Just remember that I am not a licensed or registered financial advisor or planner. So to book a session, go on my website, passiveincomeinvesting.ca, and right there on the homepage on the left hand side, there is a small video. Watch that video to know how to book a one-on-one properly with yours truly. Also on my website, you could purchase my digital product, the Ultimate DIY Investing Package, which is on version 4 right now. It comes with lifetime updates, so you only have to buy it once. And this is really a reference tool or a companion tool to help you build your own portfolio according to your needs and your objectives. It has lists of funds. It has sample portfolios for both Canadian investors and American investors. So make sure to check it out on my website. I actually created a video which shows the product from A to Z because I don't want you to spend money unless you know exactly what you're getting. So make sure to check that video out on my website. And don't take my word for how good it is. Check out the reviews. There's over 300 of them, and they are all 100% real reviews. So here's some more updated news or recent news. I am now on Blossom, a new investing app designed for investors. I've been using it for a few weeks now. I think it's really great. It has a really cool feature where users could actually add and share their portfolios and what they're buying and selling every day. So you could actually link your investing account so it's updated automatically on a daily basis. I recently added my own main portfolio so you could follow how my portfolio is doing live and what I buy every month. Really cool. It's like a mix of Facebook and Twitter, but specifically for investing. So get on your phone, click on the link in the video description below and download the app. It's 100% free, so you too could share your portfolio. Just remember to look for me and follow me. My username is Adrian, PII altogether. Also, I do have a referral link for Questrade, so you could get $50 worth of free stock purchases. This is the Canadian discount broker that I use and I recommend. Unlike Wealthsimple, the other popular discount broker in Canada, you could drip everything you want. It has all the stocks and it also has dual currency accounts. Very convenient if you're buying both Canadian stocks and American stocks. I have a Questrade video, by the way, which gives you a little tour of the features, so make sure to check that out. I also have a referral link for PASSIV. This is the portfolio tracking tool that I use to consolidate all our accounts to get a nice bird's eye view, so you can consolidate all the information together for easy tracking and stats as well. Also, our Facebook group, Passive Income Investing, is now an invite-only private group. So to join it, you need to click on the link in the video description below and give the group a like to get invited. So we take pride in making this one of the best investing Facebook groups out there with over 13,000 members. There's no scams, there's no spammers, and negative and doomsday people, we kick them out right away. Also, follow us on Instagram if you want a little bit more of our personal journey here in Panama. And lastly, just remember everyone, I am not a licensed or registered financial advisor. This channel is all about my personal investing journey and how I invest to generate high passive income from a diversified portfolio of high yield funds. It's for educational purposes only, so don't forget to do your own research and due diligence. And of course, stay safe everyone, stay healthy, and of course, stay passive. See you next time.